let's take the discussion forward with someone who looks at data very closely. Vinod Karki of ICICI Securities is here with us. Vinod, I was going through your very interesting report, and I always enjoy reading your notes. And you're saying that you're making a case that there'd be a kind of a tug of war between liquidity being sucked out gradually overseas and at the same time earning cushion on the other hand as far as the real corporates go. In such a scenario, when we have such a good amount or decent amount of returns under the belt for the last 2 years, how could this year turn out? How should investors keep their expectations from a return point of view?
Yeah, thanks, Ajay, for the question. So, as you rightly pointed out, the market is, two counterbalancing forces are acting on the market right now. On one hand, you see the normalizing of liquidity and interest rates, which will obviously have a downward effect on equity valuations. But on the other hand, we are seeing a 2-decade low profitability, corporate profit cycle rising right through the whole pandemic and recession that we had. And the earnings upgrade cycle also continuing. And what we are seeing right now is because this earnings, normalization, or you may say coming from a bottom, can fizzle out if the investment cycle doesn't follow up. So, but here we are seeing that the investment cycle, the ingredients of the investment cycle are really, falling in place, which makes us more comfortable on this earnings cycle, which is picking up right now. So, while on the other hand, valuation expansion will not continue the way it has been over the last several years, but there will be a support from earnings and investment rate picking up, basically. So that's how we see it counterbalancing. But having said that, we had a ferocious again for the fifth, sixth time during this bull rally, which started from March 20, that the market went in a straight line, from that 16.5 level to now currently around 18,300 without stopping. So, which has taken away some of the attractiveness, obviously. It was giving you high expected returns when it was below 17,000. But obviously now the upsides will be capped because we had a very sharp run of late. So that's how we see it. But nevertheless, we'll see some amount of positive gains even from these levels in this year.
Right. Before I take my second question, Vinod, I'd like to play a small slice of Prime Minister Modi's commentary at Davos last evening. Because my question is on the investment theme, especially domestic cyclicals, let's hear out exactly what did he say, making a case for India as an investment destination. We'll take the discussion forward.
साथियों, भारत ग्लोबल सप्लाई चेन्स में विश्व का एक भरोसेमंद पार्टनर बनने के लिए प्रतिबद्ध है। हम अनेक देशों के साथ फ्री ट्रेड एग्रीमेंट के रास्ते बना रहे हैं। भारतीयों में इनोवेशन की, नई टेक्नोलॉजी के एडॉप्ट करने की जो क्षमता है, एंटरप्रेन्योरशिप की जो स्पिरिट है, वो हमारे हर ग्लोबल पार्टनर को नई ऊर्जा दे सकती है। इसलिए भारत में इन्वेस्टमेंट का ये सबसे बेस्ट टाइम है। भारतीय युवाओं में आज एंटरप्रेन्योरशिप एक नई ऊंचाई पर है। फ्रेंड्स, डीप इकोनॉमिक रिफॉर्म्स को लेकर भारत का कमिटमेंट एक और बड़ा कारण है जो आज भारत को इन्वेस्टमेंट के लिए।
Vinod, what do you make of this commentary, Vinod? Do you think this is the best time for investments and the Capex cycle India is taking off? And if that is indeed the case, what's your view on domestic cyclicals like banks, capital goods, cement essentially, which do participate in Capex cycles? In the past also we've seen it.
Yeah, so Ajay, as I said earlier, if you look at the ingredients which make up the Capex cycle, the heavy lifting in the Capex cycle is obviously done by the commodity cycle, commodity companies. So we are hearing, if you must have seen, a lot of large Capex plan in these metal commodities, steel and all, being announced, and also the large energy sector investments that we've been hearing about. So this is, the animal spirits as we talk about. We are hearing about a lot of these, large-scale investments being announced in the capital-intensive sectors. And also, if you look at some of the other schemes that the government has done in terms of the PLI, even the less capital-intensive sectors like food processing, digital equipment, auto, chemicals, there also we are seeing a lot of action happening in terms of announcement of Capex. And you have to remember that, in terms of the ingredients, one is that the animal spirits have to be there. There should be, which is obviously driven by growth outlook. So that's improving. That's why the large private sector companies feel that they should be investing. Second is the availability of financial resources. So if you see the cash flows that we are seeing in the profit of a lot of these companies which are capital intensive, it's actually improved a lot over the last several years. So the availability of financial resources there, interest rates being low and liquidity being high, it's much easier for companies to avail financial resources for investing, right? So this combination of the animal spirits rising, the demand rising, and availability of financial resources and interest rates being low, and commodity prices, and now finally we are also seeing the real estate cycle, which is a very capital intensive sector, also showing signs of pickup. All this culminating into a right environment for the Capex cycle to pick up. And if the government keeps following it up with their share of investments through the budget allocation, and the states also follow up, I think it is a right mix of private and public sector investments picking up with all these other factors that I just talked about.
Vinod, what's your positioning on the most abandoned and ignored sector for various reasons in the market, which is the auto space, especially two-wheelers? Are there inquiries coming in? How's the ownership? It's not spoken about much, but early signs seem to be suggesting there are some sparks coming back after a gap of several years. Is there merit to look there on the basis of valuations or some of the resolution of issues which the sector had been facing?
Yeah, so I think there are two aspects to it. One is the demand outlook, and second is how stocks are positioned. So if you specifically talk about the two-wheelers, I mean, there is no excesses in terms of optimism or high valuation. So that gives you a margin of safety clearly in terms of valuations. And we know that some of the transient issues were there, which might go away as the economy revives and normalizes. So it positions them well, right? But we still don't know whether all the issues in the auto sector will go away immediately. But there is what you should say, some amount of caution, which is giving you some amount of margin of safety in some of these stocks. While I don't think the longer term outlook is as bad as it is being made out right now.
Mm-hmm. What's the one space which you are quite bullish on or favorable on, which is non-consensus, where people still are not paying adequate attention and could turn out to be a good one next couple of quarters in your view?
Yes, so I think clearly what we're feeling is that the whole investment cycle theory is not a consensus right now. It's still believers have they do believe in that, but a lot of people have to get their confidence going. So I think if we were to talk about it would be these infrastructure developer companies which have languished and some of the erstwhile corporate banks I think because if the investment cycle and the credit cycle has to pick up, then one can easily play this story by the large infra developers like L&T and all, and some of the corporate banks which have shown some signs of running up, but not outperformed significantly. But we know that if the cycle that we saw from 2003 to 2010, where the investment, I mean, the GDP growth was led by the investment rate and the credit growth. So if that were to play out, then these could be the leaders of the bull run that could ensure that could start because of the investment cycle and the credit cycle picking up. But obviously it will take some time to show up in data. We're seeing some improvements in credit data. The last number was close to 9.2%, which was quite good compared to the recent numbers. And also we are seeing, some of these companies in the infra space doing better. Real estate, infra. So I think these are some of the sectors where I don't think it's a consensus view that that everything is fine, and valuations are reasonable right now. It's not as high as it is for the overall market, which seems to be at a very high level. But these sectors don't give you that impression that they are at the peak valuations, whereas we think that the cycle is on the right path, going by the latest data.
Fair point, Vinod. Thanks so much for your time today. That was Vinod Karki of ICICI Securities.